This is Tom Aspray with the Viper Report Market Wrap video with an update on the markets after another war-ravaged week. And as I cautioned a couple weeks ago, I'm hopeful it'll be over soon, but I'm not confident. And the way things are going could even get worse next week. Crude oil probably not going to get much above that last high at around 122, 150 in that market. If you're a crude oil trader, who I've taught a number of them, when you're short that market, that's what they call the natural gas futures, the widow makers. Anyway, let's look at the markets. This is the summary table. It's in the front page of the all our reports. Just again to give you an idea, so the SPY was down about 1.5% last week. Qs did better, down 1.1. The Russell is worse, 1.7, I believe. And really took it in the chin was the NYSE, which is the broadest measure of the market. That's not a good sign. We would rather, that means that most stocks did go down. All the weekly ADs are negative except for the New York, and they're really close. Daily IDs all negative. You can see we're below the 20-day EMAs, and that's, always a negative, and those MAs, if you look at them, are declining. So, typically, until they start dropping, it's too early to look for a bottom. The good news is that, typically, you get up to 6% or more below the 20-day EMA. That's about as low as you're going to go before a rally. So, also below there, in the past couple of years, you've seen a 1 week drop, and then it's back to the upside. So, Stark bands are getting a little closer. 1.6% for the SPY. Most of the markets, except for the Russell and the NYSE Composite, are now below their quarterly pivots. So if we look at the chart of the SPY, you can see that this week it did close below its 20-week EMA, or excuse me, its 20-week weighted moving average. Of course, we run weighted moving averages in this platform, which is what I've always used. And in stock charts, you don't have the option of a weighted moving average. You have to use an exponential moving average. So, you can see here that this is the next major support around that 613 area. That's where we peaked out in early 25 before we had this drop. So, right now, certainly the Stark band, is looks moderately attainable there, 1.5% below where we are. This chart of the NYSE Composite shows a pretty ugly action over the past 2 weeks. Also shows a band of support here, and then major support way down here from the April 2025 or the February 2025 highs. You can see that mathematically the NYSE all is still above its EMA, as is the NYSE 80 line. Typically, I go with a weighted moving average, as I noted in that table. Of course, what all of you are probably wondering about is how bad can it get? That's always the question. And you can see from where we are, we've had the 20-day drop below the 50-day, and now the 20-day dropped on the 100-day. And you can see this green line is the next thing we'll have people talking about, which is 656, which is the 200-day moving average. So you get down into that 650-ish area, 647 I guess it is. That's 2.2% below where we are right now. If you get down to the support that goes back into the high we had in August, it's 4% lower, right, just above 637, and then down to the low 613 from early 25. That high is 7.4. Don't really think we'll get down to the 7.4 unless we start losing the war, but certainly I think we'll get down to the 2.2% and possibly in the 4% range. So looking at the daily AD lines, pretty much not much of a bounce, and there, the gap here between the AD line and the moving average, is getting fairly wide. So also that favors a rally. We have major support here, but there's some short-term support right where we closed last week. Stocks only, as it often does, is acting the weakest. It's already back down to the breakout level from November, and so it has support there. And the NYSE All, it's still above its major support. So that's a good sign since it includes the bonds as well as the stocks and the New York Composite. Still not all the news is bad. The NASDAQ Composite also is just back to support, right around 22,080, and to get back to the April lows from 25 were much lower. Number of new highs continues to drift lower. Slight increase in the number of stocks making new lows. Still no really sell signal here, though this could be the week. I'm really surprised given the number of stocks that were declining that the number of stocks making new lows has not gone even higher. If we look at the NYSE Composite by itself, you can see it's also back into a support zone here, as is its AD line. And in terms of sentiment, last week the bearish picked up and the bullish declined. We're down at 14%, so that's 14.5% more people who are bearish than bullish. Those of you who follow me for a while, like we got down to minus 38 in April to May. I really would doubt we'll see that. We could get down to minus 20, but this is a trend that suggests we probably should be at least halfway through the decline at this stage, possibly more. New York Composite also shows the same pattern, 105, new lows last week, 42 new highs. So, still not above. We're watching 200 there, and we still have not moved above that level. As I mentioned last time, the VIX and the VXN, just as the VIX chart, are in an uptrend. I was a little surprised. I thought we might get a move above this. So, that's possibly a sign that market's getting sold out, but really need to see it drop back below this level. And certainly looking at the inverse ETFs, after we get these sort of AD line signals, we typically get, a rebound, like about this time, and we didn't get it. So didn't really see any good bounces that we could look at the short ETFs. Put call ratios not severe. I mean, it peaked about 105 here, and in the index we got up to 1.1. I read some data, but I haven't been able to confirm it, that the put premiums in the last week or so were extremely high, and indicating that there was a lot of protection being put on. That's also usually a good sign, because those who want to establish a long position at a lower level have the option of selling puts to buy back the stocks. Of course, naked options are quite dangerous, so be sure you know what you're doing, and you have a stock that you want to buy about 10% lower. That's one way of doing it. An update here on the 90% chart. You can see there were a few S&P stocks that actually closed higher. Once again, this is the sharply rising 200-day moving average at about 6,600. For the 15, the S&P 1500, large, mid, and small cap, 4.6. Moderate selling here, but not really heavy. One big down day on Thursday in the NASDAQ, but still we haven't had an extreme 90 plus during the day in late February, I believe, or could have been right in here, but we didn't close with those kind of losses. So closing is usually more important when you're looking at that. So if we do get a rally like for the SPY, we'd be looking, right where this intersection here is, between about 677 up to 686, which is the March pivot. That's also the 50-day moving average. So you can see that's about 16, well, not quite 16, about 20 points above where we closed at 662. Pretty good sized move. Maybe something will happen with the Straits, or something more positive in the war will emerge. We're always hoping for that. Small caps have been hit. You can see this, the AGR. We were stopped out of a week or two ago, and you see the AD line, did make a new high, before dropping below its moving average. This suggests to me, as was the case in the NYSE and the S&P, because both made new highs just 2 or 3 weeks ago, that this is not the start of a bear market. This is just another correction. Many people that I've heard from, didn't get back in after last April 25 decline, and of course we missed. If you didn't, you missed some good opportunities. So I think this is probably the same sort of thing, but lots more uncertainties now, and also in the credit markets. Looking at the QQQs, third doji, weekly doji in a row. Technically, there was a doji sell signal last week. AD line, it did make a new high here, and no new high in price. So the lower highs in the AD line not important. You can show it's still a very strong trend here. And down below we have the weekly RS, has moved back above its moving average. So that means, it's starting to drop less than the SPY. That's generally what you see before a bottom. You start to see it hold up a little better. You can see over here, we have the MACD I chopped on here, and so in 25 midway, March, we saw a similar sort of behavior, and then of course bottomed out about a month after that. I'll look quickly at interest rates before I move on to the sector and watch list report. You can see this is a longer term chart of the yield of the 10-year. Hit this support that goes back to 23 and into 24, so pretty significant support. We're about ready to break out above this 4.3 area, so a strong close above that, given the last 2 weeks, does look likely, suggesting we move back up to that 4.5. The MACDs are just barely flipping back to positive. They were negative about a month ago, and so that's sort of maybe it's going to bump into this trading range. Hard to see anything from the crude oil picture, or the likelihood of a Fed rate cut. Of course, has gone from 100% pre-war to about 25% right now, so that's not a good sign. If we look at the shorter term MACDs, you can see we've turned positive here just near the March lows. Still looks strong, and still looks at, once again, that 4.425 up to 4.5 could be the next on the upside. Of course, rates moving higher like that will not be a positive for stocks. So looking at the ETF report quickly, you can see lots of weekly sell signals. Hong Kong, gold miners, mining and manufacturing, silver, also low volatility even, which theoretically would do well in this environment. We're still long that, but we have a less than a 2% stop, so we're going to let it ride. Industrials, Pacific, high dividend, XBI, XLB, even XLC got hit late in the week. So, only the TBD, the ultra short treasury, in line with the cards to be looked at, is positive. So if we go down here, 54% are still above their quarterly pivot, still really shifted in terms of value. It's at 63%, thanks to the oils, etc. And growth is like cloud is the only one that has a positive DTS at all. So the signals for the short ETFs are weekly and daily buys here, all red, negative on the long ETFs. So as we did in April and May, we'll start to look for a change in this behavior. So what will happen when we get to a bottom will be the short ETFs will start turning red and the long ETFs will start turning green. So we'll look at the sector report. Energy still looks really strong. PSX is a couple, some short-term sells here, but nothing to get too excited about. Materials has gotten hit pretty good, but I'm not willing to say that this uptrend is over. It's just weakening. So you can see there's the FCX, copper, Newmont, gold. We've given up some of those profits. My analysis of the gold futures and the GLD don't suggest a major top is in place. More just another trading range, which provides some great opportunities last summer. Industrials also been hit. You can see that Honeywell, some of the leaders, defense, Lockheed Martin, Deere, they're all showing. A couple of the railroads are still weekly positive, but they gave new daily sells. Consumer discretionary looks pretty negative, as compared to the industrials. You could say, if you draw a line up here, that's a top potentially, but it will only take a really good week to flip it back. Remember the green is the short term or the fast, back above the blue, which is slow. Consumer staples, you'd think they'd be a little more, they're defensive. They would do 50% positive, so, like discretion 25 negative. Healthcare has been weaker than I expected. There's still a bunch of them in here, and I still think that my longer term work favors healthcare, but the action lately has not been too impressive. This is the one that's getting really killed, financials. And, I think based on, some of the internals of the, I saw a report that there was a lot of insider buying in the financial stocks. So, assuming the world is not coming to an end, which I do, I think the financials will have some really good opportunities. Technology is getting better. You can see we moved here, so that could be the early signs of Intuit, Tax Time, Oracle, Cisco, etc., and Broadcom give a 3 DTS, but a daily negative, so mixed signals. Communications, as I said, pulled back sharply. Netflix, and Verizon, as well as Google, have some positive signals, but that's about it. They're 54%, so that's slightly positive. Utilities at 100%, very positive. We're still in XLU, and also an XLRE, 58.3%. As I mentioned to subscribers last week, one of my dear friends in the business, John Murphy, passed away in early February, and I was honored to attend his memorial service. We used to teach a course on new technicians, like in the mid '80s. So, and I hope a lot of you have read his book. I wrote a little small section, but it's something you should read. And he was quite a guy, so it was really nice to see, his children who I hadn't seen for 40 some odd years. So, he was. I have fond memories of him going to Australia and Singapore and Hong Kong. And instantly, while I was looking for something earlier today, I found an article that he had written 2010, I believe. Let me see if I can find it here. And I will be including that link to in the description of the video today, because I think you'll find it. Here we go. This is the typical John Murphy. He's developed the thing about market intermarket relationships. So I think you'll learn a lot about how he did things. Looking at this article, it's pretty extensive. I don't know how many. And I believe it, even if you're not a stock charts person, it's free, I believe. So if not, drop me a note and I'll PDF it and send it off to you. So he has a lot of good work out there. So, and much of what he taught, and as his children said, he really thought of himself more as a teacher than an analyst, and he was a very good teacher. So that's all I have for this week. Stay tuned. Viper Report will have some posts and some more charts, and hope this week is a little better than last week. Thank you.